We're very happy to have you here. Welcome to today's webinar featuring a discussion about end-of-year tax planning and some of the impacts of the new One Big Beautiful Bill Act, which was signed into law earlier this year. It's going to be a great presentation with a lot of interesting content, as well as the opportunity for questions and answers. So again, we're thrilled to have you here. And I'm looking forward to introducing our speakers and going over today's agenda. But before doing that, just like to go over a few quick housekeeping items. First of all, rest assured that your camera and microphone as audience members have been disabled. However, this webinar will be recorded, and we will be sending links out to the recording once the link is available. And although you cannot be seen or heard, we welcome your participation. If you look to the bottom of your screen, you'll see a question and answer box. And if you have a question at any point during today's presentation, we'd welcome your input, and you can click on that button, type a question, and we'll either answer it in the chat or we will take questions and answers at the end of the presentation from our panelists. We'll do our absolute best to answer all of the questions given the time constraints we have today. If we don't, though, we will make an effort to reach out to you individually after the presentation. Finally, at the end of today's webinar, as you exit, there will be a survey to complete. We'd love to have your feedback to hear about what went well and what didn't go well, and what kind of presentations you might like to see in the future. Importantly, that survey is anonymous, so if you'd like us to follow up with you directly, please be sure to include your contact information on the survey, and we'll do our best to get in touch with you very soon. So, like I said, we have some great panelists here today, and I'm going to take a moment just to introduce them to you. Joining me are two of my colleagues from the financial planning team who have both financial planning and tax expertise. Tom Goodwin has been a certified financial planner, or CFP, since 2005, so has more than 20 years experience in this profession. He's also an enrolled agent for the IRS, meaning that he has the privilege of representing taxpayers before the Internal Revenue Service. It's the highest credential that the IRS awards. In addition to those designations, Tom also recently earned the Global Financial Planner designation, meaning he has training and expertise in cross-border financial planning issues. Also joining us is Rob Sherman out of our New York office. After earning a master's in taxation in 2011, Rob earned his certified public accountant designation in 2015 and certified financial planner designation in 2017. So Rob is well versed in taxation and financial planning issues, and he's also added another arrow to his quiver in the form of the personal financial specialist certification, really deepening his expertise when it comes to integrating tax and personal financial planning matters. So like I said, a really good panel of experts who not only understand the tax code, but how it relates to our individual clients and the financial planning issues that face them today. So for today's agenda, we're looking forward to a lot of different topics. We'll cover some of the fundamentals, like how do we look at tax rates and tax brackets? What are some common year-end techniques, like Roth conversions and accelerated retirement distributions? We'll also look at charitable giving and interfamily giving, and we'll set that all against a backdrop of some of the recent tax changes codified by the One Big Beautiful Bill Act. So without further ado, I'd like to kick off our presentation and hand it over to my colleague, Rob Sherman. Take it
Thanks,
away, Rob.
So I figured before we dive into year-end tax planning, we take a moment just to look at a 1040 and make a few distinctions. So everybody, please say hello to the 1040. 1040, please say hello to everyone. A few things I wanted to point out, because throughout the presentation, we'll make references to either total income or AGI, adjusted gross income, or maybe modified adjusted gross income, MAGI, or perhaps taxable income. And those all sound very similar, but they're very different. And here's the distinctions. When you look at your 1040, this is the page one, the income section, the top half. You'll see all your income items, whether it's wages, portfolio income, flow-through income, Social Security, RMDs, whatever it may be. It all tallies up on line 9 to total income. And then you have above the line deductions or adjustments. The net amount is your AGI, adjusted gross income. And then there's below the line deductions, which are either standard or itemized deductions. The itemized deductions you're familiar with probably are medical expenses, charity, state and local tax deductions, home mortgage expense, and so on. So those items all net out to taxable income. And taxable income is important because that's what determines what tax bracket you fall into. On the next slide, I have the 2025 tax brackets. And you'll see here there are a number of tax brackets. And a common misconception is that somebody might say, oh, my income is $400,000. Okay, is it total income or AGI or taxable income? Because taxable income is the only one that matters for the purpose of looking at your tax bracket. And another distinction to make is that tax brackets are like staircases. Each bracket you're taxed accordingly. And then, so it's not that if you have $400,000 worth of taxable income, you're not taxed on every dollar 35%. It's just the dollars between 250,000 and change up to 400,000 would be taxed at 35%, and so on and so forth. So although these are the marginal tax rates, the effective tax rate is essentially a blended rate. So for 35%, your effective rate might be more like 30 or 31%. Next slide, please. So now we took a moment to talk about the tax brackets and just take stock of where we are. Tax planning for year end. So throughout the year, and often with conversations you'll have with your financial advisor, you're coming up with a capital gains budget for the year. Capital gains are when you realize when you sell an investment during the year. If you owned it for more than 1 year, it's a long-term capital gain. If you owned it for less than 1 year, it's a short-term capital gain. Short-term capital gains are taxed as ordinary income, whereas long-term capital gains are taxed at a separate tax rate. It might be 0, it might be 15, it might be 20, and it also might be subject to net investment income tax. So those are the direct implications. So if you sell a security during the year, you'll be subject to capital gains tax or ordinary income if it is a short-term capital gain. But also throughout the year, if you sell investments at a loss, you could offset those capital gains and potentially entirely eliminate your capital gains tax. And if you have losses in excess of your capital gains, you can carry forward that capital loss, carry forward indefinitely. And $3,000 of that capital loss would offset ordinary income, and the remaining balance would be carried forward indefinitely until fully used up or until there were a death. So those are the direct implications of capital gains and managing your capital gains budget. But there's also indirect implications. For instance, if you were not conscious or mindful of your capital gains, you could inadvertently trigger yourself into a higher IRMA bracket. IRMA, for short, is just the essentially the premiums you pay for Medicare Part B and D. So if you're not conscious of your capital gains, which will feed into your modified adjusted gross income, and the distinction between AGI and MAGI is that it adds back tax-exempt interest. Example of tax-exempt interest would be interest from muni bonds, assuming they're tax-exempt. So if you're a New York resident and you bought a New York muni, it would be exempt from Fed, state, and potentially local income tax. So restructuring your portfolio just to be entirely in fixed income or munis, although it will reduce your taxable income, it will not reduce your modified adjusted gross income for purposes of determining your Social Security, your Medicare premiums. Another thing to be mindful of is the taxation of Social Security benefits. So your Social Security benefits are subject to ordinary income tax, but not every dollar. At most, 85% of your Social Security benefits will be subject to taxation. And that determination is whether it's 15%, 50, so 1550, or 85% subject to taxation. And it goes off of combined income. So combined income is essentially modified adjusted gross income because it's AGI plus tax-exempt interest, plus 1/2 of Social Security benefits. So for a single filer, once that combined income exceeds 34,000, 85% of your Social Security benefits are subject to taxation at whatever tax bracket you fall into proportionally. And if you're married filing jointly, that number is 44,000 of combined income. And these are all unchanged from the One Big Beautiful Bill. These are extensions of the Tax Cuts and Jobs Act for the tax brackets, and they're all adjusted for inflation. Next slide, please. When I was talking about the IRMA brackets, these are the brackets for a single filer. So if you were to exceed the bracket, so looking at the highest bracket, $500,000 of modified adjusted gross income, you have the base amount of 185 plus an additional $443.90 for Medicare Part B, and the additional $85.80 for Part D. And that would be per taxpayer per month. This, like I said, is the single filer bracket. There's also a separate bracket for married filing jointly. And that bracket, the highest threshold is 750,000. But in many of the other brackets, it's just double. But in some spots, it's not exactly double. Next slide, please. These are other notable and hot topics from the One Big Beautiful Bill. The enhanced senior tax deduction. So this was originally marketed as no tax on Social Security. So there is tax on Social Security, but to offset the tax attributable to Social Security, the act has an enhanced senior tax deduction of $6,000 per taxpayer. There are income phase outs for single filers with AGI in excess of 75 versus 150 for married filing jointly. You begin phasing out, and you're entirely phased out at 175 and 250 respectively. So this deduction is in addition to and separate from whether you take the standard or itemized deduction. The standard deduction for 2025 is 15,750 for single, and then times two, 31,500 for married filing jointly. And whether you itemize or take the standard deduction comes down to whether your itemized deductions exceed the standard deduction. Another key distinction is that you don't have to be collecting Social Security to claim this or be eligible for this deduction. As long as you're greater than the age of 65, you're eligible for it. So you could potentially be postponing your Social Security benefits until age 70 to have the deferred growth of the monthly benefit, but still be eligible for this deduction. So it's not exactly offsetting Social Security because it's anyone's eligible whose income is in line with the guidance and above age 65. Earlier I talked about whether you're itemizing or taking the standard deduction. One of the key itemized deductions, and this was a very important topic that was argued back and forth over multiple years now, is the enhanced SALT deduction, state and local tax SALT. Under the Tax Cuts and Jobs Act, it was capped at 10,000 and is now increased to 40,000. And there are some income limitations. If AGI exceeds $600,000, whether you're single or married filing jointly, you don't get that benefit of the 40. But there's a phase out that starts at 500 up to 600, and if you're below 500,000 of AGI, you get the full $40,000 deduction, and that's not permanent. Where all the other changes I've mentioned thus far, well, every other prior slide was made permanent. What does permanent mean? It just means that it's the law, it's not sunsetting, and it would require an act of Congress to change it. So it's permanent until it's changed. And this deduction it phases out at the end of 2029. Next slide, please. Another very popular year-end tax planning item are Roth conversions. And you might hear this term often, whether you might hear Roth contributions, Roth conversions, you might hear, it's a very common topic that comes up for year-end tax planning. So who is it? What is it? When would you do it? Why would you do it? Taking a moment to point out the difference between traditional and a Roth account. A traditional IRA is dollars you never paid tax on, whereas a Roth IRA is dollars you already paid tax on. So you're either paying tax when the money goes in or when it comes out. Money goes in, it's traditional, and you pay tax on it already. You haven't paid tax on it, you get a deduction when it goes in. Whereas Roth, you don't pay tax when it comes out because you've funded the account with post-tax dollars. So not everybody can make contributions to a Roth IRA. One, for any retirement account contributions, you must have earned income. Setting that aside, there's income limitations for a Roth IRA. So some people make too much to contribute to a Roth, but there's no limitation on who or how much you can convert. A Roth conversion is taking money from your pre-tax dollar account and converting it to post-tax dollars. So you take your money from your 401k or your IRA, you never pay tax on it, and you convert it to a Roth, and you pay tax on every dollar of it. So if you convert $20,000 of your traditional IRA to a Roth, you have additional taxable income of $20,000. However, there are instances where somebody might have made post-tax dollar contributions to a pre-tax dollar account. And an example of when that happens is potentially a backdoor Roth conversion. And the most ideal fact pattern for this is, let's say if you're currently employed. So let's say you work at F.L.Putnam, like myself and Tom and Scott. Let's say if you never had a prior job, F.L.Putnam is the only place you've ever worked. So all my retirement dollars are in my 401k and nothing in my IRA. If I wanted to, I could take $7,000. I can open up a traditional IRA, make a non-deductible traditional IRA contribution of $7,000, and then immediately convert it to Roth and pay no tax for doing so. The reason being that in every other reference I've made to traditional IRAs, your basis is zero because you never paid tax on those dollars. But if I'm putting $7,000 into a traditional IRA and I'm not eligible for any tax deduction for doing so, my basis is $7,000 because it's post-tax dollars I'm putting into there, not pre-tax dollar. I can take that seven and convert it right away, and now it's in a Roth. It's exempt from RMDs, and it's growing indefinitely until I die, and it would go to heirs, and they'd have 10 years to deplete the account, and they wouldn't pay tax on it either. So it's growing my lifetime plus 10 years to heirs. There are instances where people will try to do this, and they have money already in a traditional IRA. So that's where the basis is so important. So for an example, let's say if you had $93,000 in a traditional IRA and your basis is zero, and then you try to do a backdoor Roth conversion, we put $7,000 into that account. So recap, the account value is $100,000. Your basis is seven. If you were to convert that $7,000 right away, you can't cherry pick which dollars you're converting. It goes off of proportionality. So only 7% of your conversion would be tax-free, and 93% of your conversion of that $7,000, 93%, whatever that number is, will be subject to ordinary income. So, it's not everyone is ideal candidate for doing a backdoor Roth conversion, but when a Roth conversion might make sense is, you're in a low tax year, there's a large market correction. So if the market were to have a 30% pullback and you were to cherry pick, okay, I'm going to convert all of my Apple stock over to my Roth IRA, you could do something like that. A low income tax year might be because you're newly retired and you haven't started drawing on Social Security yet, so your tax bracket is much lower. Or you have a lot of you've made a big philanthropic gift that year, so you have more itemized deductions, or you have large medical expenses, again, which would reduce your increase your deductions and reduce your taxable income. So those are all examples of when you may or may not do a Roth conversion. Next slide, please. And talking about IRAs, I'll turn it over to Tom now.
Thank you, Rob. Yes, retirement distributions is a big issue with everyone. We all hope to retire at some point in time. And RMD is the acronym they use, required minimum distributions. When you have IRAs and employer accounts, there's a certain age at which you have to start taking money out of those accounts and paying tax on them. Currently, that starting age is 73 for everyone who was born after 1951. For those who are older, you may have remembered starting at 70 and a half or at age 72, because that number, that starting age, has changed over time, and it will change again in the future to age 75 for anyone who was born after 1960. But that's still 8 years in the future, and they may change that now in the next 8 years. We don't know for sure, but right now it's age 73. Everyone asks, how are we calculating these minimum distribution amounts? And it's determined based on the value of the account at the beginning of the year and what your age will be at the end of the year. And for figuring out the factor based on your age, there's what's called the Uniform Lifetime Table. This is a table of life expectancies, and it's based on your age and it assumes that you have a spouse that is 10 years younger than you. So they created this as a uniform table that is applicable to almost everybody. The only exceptions would be if you have a spouse that's more than 10 years younger than you, there may be a different way that they calculate the withdrawal factor. Another thing that is asked is, what if I get to age 73 and I'm still working? Do I still have to take those distributions? Because I'd be contributing into the plan at the same time I'm taking it out. With IRAs, you must still take that required distribution. But if it's an employer plan and it's for your current employer, you may be able to delay those required distributions until you retire. If it's a former employer's plan, it doesn't count. You still have to take the distributions. And if you are more than a 5% owner of your current company, you can't delay those distributions. So there's a couple caveats in there. And lastly, Roth IRAs do not have any required distributions. And mostly that's because there is no tax consequence to taking money out of your Roth IRA. You've already paid tax on the money that's in there. It's not going to be taxed on the way out. So they really don't require you to take it out. They want you to take the money out that they're going to collect taxes on. And I think I have a case study here. Let's look at a client who's age 73, who has a spouse age 65. That's less than 10 years younger than them. So they're using the uniform lifetime table. And at age 73, the factor is 26.5. So if you had a $1 million IRA and you're age 73, you have to take $37,735, roughly 3.8% of the value of that account has to be taken out in that year. So that's how RMDs work. Next slide, we have what are termed inherited IRAs. These are not your IRAs. These are IRAs where you were named as a beneficiary and it has passed to you when the original owner passed away. If that original owner passed away before 2020, and 2020 is the year that the bill called Secure 2.0 was passed. Any inherited IRAs prior to that point, you have to take a distribution based on the owner's age when they inherited this IRA. And it doesn't come off the uniform lifetime table, it comes off a single lifetime table, which accelerates the payments on it. If the original owner passed away after 2020, after the passing of Secure 2.0, there still is that required minimum distribution requirement, but they've layered on this extra requirement that all money has to be out of the inherited IRA within 10 years. And they allow for a few exceptions to this rule, and that's for what they call eligible designated beneficiaries. And these would be spouses, minor children, the disabled, and the chronically ill. For spouses, they have the option to continue to take the distributions on their deceased spouse's schedule, their RMD schedule, or they can roll it over and merge it into their own retirement assets and then can take it on the uniform lifetime table that is applied to them. For minor children, this 10-year rule does not begin until they turn 18. So in essence, if a minor child inherits an IRA, they have until they're 28 years old to liquidate the entire account. And then the further wrinkle is sometimes the person who inherited an IRA passes away. and it goes to another level of beneficiaries. You have to understand that even though it passes to another inherited beneficiary, it doesn't reset those RMD schedules, and it doesn't cause a new 10-year rule to come into effect. The original 10-year rule still applies. And again, on the next slide, I have some case studies that show this. Here, we'll take our same 73-year-old client, and in this case, they've inherited $500,000 from their mom who passed away in 2024. So according to the single lifetime table now, the factor is 16.4. So in 2025, based on $500,000, they would have to withdraw $30,487. Now I have a couple tables down below that show what happens to an account if we get an average growth rate of 6%. On the left-hand side, they take just the minimum required distribution. You can always take more than the minimum. You get penalized if you take less than the minimum. So if they just took the minimum for the first 9 years, in the 10th year, they still have $381,000 in that account that they have to take out all in that year and get taxed on all $381,000. So instead of taking just the minimum, if the 10-year rule applies, it's better to look at leveling out those distributions over the 10 years. In this case, $500,000 would require a distribution of about $64,000 a year. And you can see $64,100 over the first 9 years leaves $63,950 in that last year. So you've evened out the tax liability and the cash flow that you would get out of this account, and you don't get hit with that big tax hit in that last year. Next slide. A lot of people ask, well, is there any way I can avoid paying tax on part or all of these IRA distributions? Because in some cases, people do not need these distributions for their current living expenses. So there is a provision in the tax code called the Qualified Charitable Distributions. Again, an acronym that we use, QCD, Qualified Charitable Distributions. You're eligible to do these when you hit age 70 and a half, which was the original RMD age before they started changing it. They never changed the law as it applies to qualified charitable distributions. These distributions can be taken from any IRA or inherited IRA, but not from employer plans. It's only for the IRAs, and taking advantage of this may be one of the important reasons to move an employer plan over to an IRA when you retire. A qualified charitable distribution goes to a 501c3 charitable organization. It has to go directly to that organization. It can't go into a donor-advised fund. They're not eligible for this. And I'll explain in a moment what a donor-advised fund is and how it's different. These QCDs are limited to $100,000 a year. And the important part is the amount you donate counts towards that required minimum distribution, but it also reduces the taxable amount of the distribution. And I have a case study on the next slide here that we have. Let's take our 73-year-old client, but now he's widowed, so he's a single tax filer. He again has that $1 million IRA, and he has that required distribution of $37,735. We can look at maybe last year, before he was required to take distributions, he had taxable adjusted gross income of $76,000, and his federal tax liability was about $6,000, $5,940. This year, he has the same income, but you have to add the required distribution on top, and he now has $113,736 in income. And his tax liability has now gone up to $15,078. That's an increase of over $9,000. Not only that, he's gone over that IRMA threshold, and his future Medicare payments will be subject to an additional $1,052 of Medicare payments. But if he took, instead of taking that $37,000 RMD as taxable, if he made $10,000 of that a charitable donation, his income would have dropped to $103,736. His taxes would drop to $12,746, and he would go below that IRMA threshold, and he wouldn't pay any increase in Medicare premiums. So on a $10,000 charitable contribution, he would have saved $2,300 on his taxes and $1,000 or more on his Medicare premiums in the future. That's almost $3,400 of savings. In essence, it cost him out of pocket $6,600, and the government contributed the other $3,400. Basically, for every dollar that he put into this contribution, the government gave him 50 cents on the dollar as additional charitable contributions. So it can be a very powerful tool to use to help reduce your taxes and navigate your way around these Medicare adjustment amounts. Now, charitable gifting in the more broader sense, we just talked about these QCDs coming out of IRAs and how beneficial they are. Some of the other gifting techniques that can be used are to donate appreciated shares of a stock. Say you have a stock that you paid $10,000 for that's now worth $50,000. If you sell that, you're going to pay capital gains tax on $40,000. Suppose you want to make a $50,000 charitable gift. If you sell the stock, you pay tax on the $40,000 and then give cash to the charity. They get $50,000, but you have the tax liability probably at 15% of that $40,000. You're liable to have a $6,000 tax liability. If in turn you take that $50,000 of stock and donate it directly to the charity, you get a charitable write-off for the $50,000. The charity sells the stock and doesn't pay any tax on it, and you've avoided that $6,000 capital gains hit on the appreciation on the stock. So that is the power of gifting appreciated shares of stock. And I mentioned earlier that I would talk about donor-advised funds. A donor-advised fund is basically a charitable bucket. It allows you to donate and take the tax write-off for donations by putting the money in this donor-advised fund. And then down the road, the only place that distributions from these donor-advised funds can go is to a qualified charity. But it allows you to, say, donate $50,000 in a given year, and then maybe make $10,000 worth of donations over the next 5 years. And the advantage here is you would get a charitable write-off for the money as it goes into the donor advised fund. So you'd get a $50,000 write-off this year, and you wouldn't get any additional write-offs as the money goes out to the actual charities in the future. The advantage here is that if you did $10,000 a year, that $10,000 a year would probably still be under the standard deduction level, and you wouldn't get any tax benefit for it. By clumping those donations together and putting it in a donor-advised fund in 1 year, you now have a write-off that far exceeds the standard deduction. So you would get some tax benefit for the donation in that year. And then in the years that you donated out, you wouldn't get any benefit. But if you were under the standard deduction limit, you wouldn't get any benefit for them anyway. So that's what a donor advised fund does, is it allows you to group your future donations together into a single year and then pay it out over a number of years. There are some additional wrinkles that the One Big Beautiful Bill has implemented on charitable gifting. We have an illustration of those on the next slide. And Rob, I believe you're going to explain this.
Yeah, thanks, Tom. Yeah, here's a quick example of the impact comparing the current deduction rules versus how it will work starting January 1 of next year under the One Big Beautiful Bill. So here's an example, and just big round numbers. If somebody's adjusted gross income were $1 million and they were to contribute $100,000 to charity, right now, how it works is they have tax savings of $37,000. That's because they're in the highest tax bracket, 37%. So 37% of $100,000, $37,000 tax savings. However, under the new rules, there is a 0.5% AGI limitation. So in that same example, if you have $1 million AGI, 0.5% is $5,000. So you'd apply that 0.5 point deduction to your donation of $100,000, and you'd only be eligible to deduct $95,000. And from there, the $95,000 deduction is capped at 35, opposed to the highest tax bracket, 37%. So that would be $33,250 versus the old amount of 37,000, in assuming everything else were equal. So the difference between the two is $3,750. And it's essentially about a 10% difference in weighting. If all things else were consistent between 2025 and 2026, you'd have more tax savings. It'd be more tax advantageous to make that gift this calendar year, opposed to waiting until January 1st of next year. I'll turn it back to Tom now.
And the last subject we'll touch on today is family gifting. And there's two ways you can gift to family members, either during your lifetime or gifting as part of your estate, what are called testamentary gifts from your wills and your trusts. But in your lifetime, you can gift from one generation to another, to children, grandchildren, to anyone, actually. There's an annual exclusion amount currently at $19,000. So any one person can gift to another person $19,000, and they don't have to do any record keeping of that gift. There's also gift splitting that allows you can give $19,000 to a child, your spouse can give $19,000 to that child. So now that you can pass from a couple down to any individual $38,000. And if your son or daughter is married and has a spouse, you can gift to that spouse also. So from a couple at one generation to a couple at another generation, you can actually gift $76,000 a year without having to do any special record keeping. And by special record keeping, I mean filing a gift tax return with the federal government. It should also be noted that educational expenses, when you pay tuition for another person, that is not part of that exclusion amount. That can be done in excess of the exclusion amount, and the same goes for medical expenses. It should be pointed out that when you gift to someone, if it's cash, the basis of that gift is the amount of cash that you gave. If you gift stocks or other investment securities, a piece of artwork or something that you bought, the basis that they receive it at is what you originally paid for it. So you could gift 19,000 to someone, but if it's $19,000 worth of stock that you paid $4,000 for, if they sell it in turn, they have to record the capital gains as if they bought it for $4,000. Testamentary gifting is a little bit easier because upon your death, all of the assets in your estate get a step up in basis. Well, I shouldn't say all of them. All of the taxable assets in your estate get a step up in basis. Your IRAs and annuities are items that do not get a step up in basis, and you can pass a tax liability on. But when you pass away, you also file an estate tax return, and this is where you reconcile if you did make taxable gifts during your lifetime, they come back and get added back in on your estate tax return. But for 98% of the people, estate tax returns result in no additional tax, because right now the limit is 13,990,000, and it's going up to 15 million per person next year. So, and again, the one big beautiful bill removed the sunset that would have cut those numbers in half, and has instead extended those caps permanently, or as permanent as any piece of the tax code is. So that is the information that we have for you today. Scott, have we received any questions?
We have, and first of all, thanks Rob and Tom for covering all that information. Certainly a lot to take in there. And we do have a few interesting questions for those in the audience who might not know. There's a Q&A button at the bottom of your screen. We'd welcome any additional questions you might have, and we'll do our best to answer them here live. If not, we'll tackle them via follow-up after today's webinar. So for the first question, Rob, you actually typed an answer to this one, but I want to tie in another somewhat related question and ask if you can speak to that as well. One of our audience members was asking if there's any sort of limit on how much can be converted to a Roth IRA in any given year. And following along from that, because there are tax implications for Roth conversions, how do you go about paying those taxes? Can you withhold taxes on a conversion much like you would, if getting a check from your IRA for your
Good
RMD each
question.
year?
Yeah. So yes, there is no limit on how much can be converted to a Roth IRA, but when you are doing the conversion, you typically want to make sure you have the cash available to pay the tax, because if you were, let's say, converting that, let's say $10,000 and you're withholding 25 or 30% of the conversion amount, so let's say if it's 30% and it's a $10,000 deduction, you only have really converted 7, opposed to converting full 10. So a Roth conversion makes more sense when you have the liquidity available outside of retirement, whether it's a brokerage account or in your bank account, whatever it may be, to pay that tax. And the tax will be paid either when you file your tax return, or if quarterly payments are required given your fact pattern. And a fact pattern when quarterly payments are required are you're trying to avoid underpayment interest because there's no withholdings on your other sources of income.
If I can add, if you're under 59 and a half, the portion that didn't go into the Roth may also be subject to a 10% penalty on it as a early distribution.
Thanks, Tom. For our next question, Tom, I think I'll ask you to take this. If you could just clarify again, you outlined some different rules for inherited IRA distributions.
Yeah.
Relating to family members or qualified individuals versus non-family members. Can you speak to that and distinguish between, what happens for each party and what requirements are present for both types of beneficiary?
Okay, thank you, Scott. The only special classifications are those eligible designated beneficiaries, where they're either your spouse, they're your minor child or grandchild, or they have a disability or chronic illness. Everyone else, whether it's a relative or not, is all considered in the same class and is subject to those required minimum distributions every year and the imposition of the 10-year rule, where all of the money in the account has to be liquidated out of the inherited IRA within 10 years. So it doesn't make a difference whether you're giving it to your brother or whether you're giving it to a close friend. Bloodline does not make a difference in that beneficiary designation. Did that answer the question?
So certain people can continue to take small lifetime distributions if they are part of a very select group. Everyone else is subject to the 10-year rule, basically.
Yeah.
So no one is free from having to take distributions, basically.
Yes, and the minor children, they take a very small distribution, and then when they turn 18 and are no longer a minor, that is the starting point of that 10-year rule. So they have until they're 28 to take all the money out.
Got it. Thank you. This could go to either of you. The question is about thrift savings plans, which are retirement plans often for government employees. And if a TSP or thrift savings plan is subject to the same required distribution rules as IRAs and 401ks, and is it subject to the same Roth conversion provisions?
I can take that. Thrift savings plans are the government equivalent of a 401k or a 403b. And they have the same rules in that if you're still working when you're 73, you don't have to take a distribution from them. It should be pointed out that if you retire during a year, you have to take a distribution that year. It's all based on whether you're still working on the last day of the year that is important. But you can roll them over to an IRA like you can with a 401k and 403b. When you retire, you can't make the QCD, qualified charitable distributions, from the thrift savings plan directly. So again, that's a reason that if that's something that you want to do to reduce the taxable distributions, then you do have to move it to an IRA.
Thanks, Tom. There was one question about qualified charitable distribution limits in 2025.
Yeah.
I believe the limit has been indexed this year to 108,000,
Yeah.
and I believe that might have been misquoted earlier in the presentation, but 108,000 is indeed the limit for a qualified charitable distribution in 2025.
Yeah. When the rule was made permanent, it used to be that it was a rule that was postponed annually, and everybody would wait until the end of the year to see if it would be postponed. So a handful of years ago, it was made permanent at 100, and it's been indexed to inflation from that point. So yeah, for the last 2 or 3 years, it's increased marginally since then. But it's common practice just to refer to the initial rule of 100. But yeah, correct, it is 108,000 per taxpayer for 2025.
Thanks, Rob. On a different topic, we talked a little bit about gifts and gifts to family members. Rob, could you speak a little bit about the rules regarding gifts in the form of tuition payment for family members or non-family members, and whether that requires any type of special filing?
Sure, absolutely. So if the gift is paid directly to the qualified education institution, so if you're paying your niece, nephew, grandchild's tuition directly to the university, it's exempt from the $19,000 annual exclusion amount. It could be $50,000 or $75,000 a year to some private school, and there's no gift tax implications. The only other carve out like that is for medical expenses, but it has to be paid directly to the institution. If you were to give that $50,000 check to your grandkid and have them pay the tuition, you've made a present interest gift of $50,000. I would have to file a gift tax return form 709 to report that gift and use up some of your lifetime unified credit amount.
Got it. Thank you. Let me see. A couple of questions regarding designating a trust in your estate plan or on your retirement accounts as beneficiary of your IRA or retirement plan. How does a trust as beneficiary differ from an individual as beneficiary, and how do those RMD or 10-year rules apply to trust as beneficiaries? Tom?
Well, trusts can kind of complicate things a bit. If they're not worded properly, there is a chance that they may impose a 5-year rule instead of the 10-year rule. But in most cases, the 10-year rule will still apply. What a trust as a beneficiary does is it prevents the issue of inheriting an inherited IRA. So the distributions still have to happen from a RMD standpoint. The factor for the RMD is usually based on the age of the oldest beneficiary of the trust. So again, in the example that I had, if it's a 73-year-old is the oldest beneficiary of the trust, even if the trust is distributing to 5 people. If the oldest one was 73, the factor would be 16.4, and that number would be applied to the balance. The distribution would happen to the trust, and then the trust would determine how the money gets distributed out to the ultimate beneficiaries. What it does is it also takes out if one beneficiary passes away, it doesn't roll to another generation. The trust is the determining factor on who the ultimate beneficiaries are. But it's the RMD schedule is based on the age of the oldest beneficiary of the trust at the time that the inherited IRA went into the name of the trust.
Great. Rob, speaking about the state and local tax deductions, if somebody has 2 homes and their primary residence state and local taxes do not add up to the full 40,000, can they use a secondary residence or vacation home related expenses to count towards that 40,000 limit, or is it primary residence only?
Tom, are you sure on that one? I think it's okay. I had to check. I don't know.
We stumped the experts.
I think what all property taxes get rolled in on your itemized deductions under the section taxes. All your income taxes, your sales tax, your property taxes, they all get rolled into it, whether it's property taxes on your primary residence or a secondary home. It all goes on to the itemized deduction, and once that category is totaled up, the $40,000 cap is applied to it. So if you don't reach it based on your primary residence, the fact that you're reporting taxes paid on a vacation home or second home that pushes you to that limit, there would be some use to it to reach that cap.
Yeah, it's not like the mortgage deduction where like it's primarily, the new rule is your primary residence.
Yeah.
Got it. Thank you. Let's see here. This is an interesting one regarding 529 plan assets for individuals that own 529 plans and don't end up using all of the funds in that account. We know that there are some rules about converting some of that money to IRA accounts. How does that work, and can you convert it to an IRA in the name of the same beneficiary of the 529 plan? And what sort of limits apply to that?
Yeah, I think between Tom and I think we can handle that one. So the limits are, it's the same limitation for this conversion as there is the contribution, which is $7,000 a year, for a max lifetime conversion amount of 35,000. There's specific rules where the account has to be open for five years, right, Tom?
Yeah.
And I don't know, so this one I haven't looked at it recently, so there's a lot of nuances to it. Tom, am I missing anything from that one?
No, I don't think so. I think
Yeah.
there's a minimum age that you have to achieve with the money in the 529 plan before you can start moving it over, and there's that
Yeah.
lifetime cap.
And then also you have to have earned income because the same rules would apply as if a contribution. So like for instance, if it's dependent or if it's somebody who's retired and changed the ownership of the 529 to themselves, it doesn't work. You have to have earned income to make this conversion. Whereas typical like if you look at a Roth conversion, you don't have to have earned income to do a conversion there. But in this instance, you do need a earned income to up to $7,000 to do a $7,000 conversion from your 529 to your Roth IRA or
And
IRA.
I'm just seeing from another one of our illustrious colleagues that the um, lifespan of the 529 plan, it has to have been open for 15 years in order to be eligible to start making conversions from
Yeah,
529 to IRA.
it has to be open for 15 and the funds have to be in there for 5. Yeah, that's what it is. Yeah,
Okay.
15.
So yeah, follow up for more information on that one because again, the rules are fairly specific when it comes to those conversions, and that's still a relatively new provision. So we've got time for one more question, and this is something I hear a lot from clients. There was a change in rules on required distributions for inherited IRAs. And so we have a lot of folks who inherited IRAs 15 or 20 years ago, and they're paying lifetime distributions. And it's very possible that they could pass away and still have balances in those accounts. So which rules apply to the beneficiaries of a beneficiary? In other words, if I have an inherited IRA and I pass it on to my children, are they subject to 10-year rule, lifetime rule? How does that work?
Again, if the original owner died before 2020, there's what is called a stretch IRA, and it's being paid out over the original inherited owner's lifetime. If that person dies and it passes to a second beneficiary, the RMD schedule does not change. It does not invoke a 10-year rule if there wasn't a 10-year rule in place to begin with. So you don't then change the RMD schedule to the life expectancy of that second owner or second inherited owner. It stays with the schedule of the original inherited owners. So if they had 6 years left on their distributions, the second person who inherits it gets paid out over 6 years. But like I said, those are minimum requirements. They can always pay it out faster if they want.
Got it. Well, I'm looking at the clock and we're just over time. So we still do have some open questions, and I regret that we couldn't get to everything. But again, if you would be so kind as to fill out the survey, and if you'd like follow up either to answer a question or if there's something else you'd like to hear about from us, please be sure to include your contact information. Thank you again, both Tom and Rob, for all of your expertise and covering what can be a dry topic in a very interesting way. And thanks to everyone in our audience for being here. And we look forward to doing this again next quarter. So thanks again, and we hope to see you soon.